Cheers.
So you guys, welcome to the first, I'm gonna take a sip real quick. Friday 5. It's 5 o'clock somewhere. So we are having our tasty beverages, local, of course. And I'm sitting here actually with Matt Cochran, co-owner and founder of Fountain Mortgage. You guys are a local lender.
We are. We opened up 9 years ago.
Okay.
In 2013. So we're in Prairie Village, 75th and Mission Road, and we are 100% organic, homegrown, local lender.
Yep. You guys hear me a lot in my videos. I say always, always, always work with a local lender because they know the area better than anybody. So here we are, 75th and Mission. It's almost 5 o'clock. We're cheating a little bit. But I'm gonna quickly ask Matt 5 questions about what's going on in the market. So as an agent, I work with a lot of buyers and they are asking what the heck is going on with the market right now. Are we going to see another 2008? So that's my first question.
Okay. We do get that question a lot. I don't think that we're going to see another 2008 because the mortgage industry and the rules have changed a lot. So a lot of those risky mortgages that were issued back in the late 2000s as we rolled into 2008 and 9, those really don't exist. So we're not headed towards all of these foreclosures with people underwater, things like that. I think that we may be headed towards a little bit of a recession.
The big R word.
Yes. Just with
a drink.
Yes,
not to that. Not drink to it, but
no.
Here's to hoping.
Yes. The market is very heavily weighted towards sellers right now because there's just not a lot of inventory. So a lot of these buyers are competing and driving the prices up in a lot of cases. But I do not think that we are headed towards 2008. I think that the possibility of a small recession is there, as the Fed increases the prime rate, which is really tied to consumer spending, so credit card rates, auto loans, things like that. That may cause some consumers to pull back on their spending, which can create a little bit of a recession. So when that happens though, one of the side effects that can be a benefit are mortgage rates tend to come down a little bit.
Okay.
So that can help to spark some of the housing activity.
Okay, so then my second question is mortgage rates are not going down, they are going up right now. But I know that COVID was very different in terms of what went on with lending and mortgages, and why are they going up if we're potentially entering a recession and not going down right now?
Well, good question. We're not quite there entering a recession, but they are going up because inflation right now is a major issue. So when the Fed increases that prime rate, then that can help to taper off the inflation problem. And in fact, a lot of people don't realize in 2018 and 19, pre-COVID, interest rates were already approaching the 5% range. Okay. So we were already headed towards this type of rate environment. When COVID hit, of course, there was just global uncertainty. So interest rates plummeted to historic lows in the upper 2s. And so everything sort of pushed pause for about 2 years. And now that we're coming out of COVID, whatever it may look like, now the Fed is acting as it would back in 2018 and 19 so that rates can stabilize and get back on track to where they were headed.
Okay, so historically speaking, if you go back 10 years, 15 years, where were rates then versus where are rates now? And should we really be freaking out about high interest rates? Are they even that high?
They're not. Overall, if you look at even the 80s when some of our parents were buying, they were in the 15-16% range. Okay. So that's
high. That feels really high compared to where we are right now.
Very high, yes. So as we rolled into the 2000s, we were seeing the 6%, 5% range.
Okay, which is kind of where we are right now.
Yes.
Depending on the day, we're in the 5s at the moment. Is that correct?
So we're headed back to where things were in like the 2008, 2009 range.
Okay.
So, yes. So if you look at a historical perspective and look at a chart of rates over the last 50 years, we're not at the all-time bottom, but when you look at it in perspective of 50 years of mortgage rates, we're still really towards that bottom end.
Okay. So I'm going to ask my third question. It might be my fourth. I'm not sure, but I'll take another drink. My third or fourth question is, are we going to see threes again soon?
I don't think that we will.
Will we ever?
I've given up on saying ever and never and those, speaking in final terms like that. Just with COVID, we saw unprecedented rates. So
right.
I don't think that we'll see rates in the threes anytime soon. But when you have buyers that are purchasing homes and rates are in the fives for a 30-year fixed rate,
right?
When interest rates dip, so if we do head towards a little recession and rates come down into the fours, and you can refinance and trim 1% off of your interest rate, that can save you $150, $200 a month. So
that's a lot of money.
Yeah, when you put in perspective, if you buy a house and you're in the fives and you have a chance to refinance down into the fours, you can still save substantial money. That can be a lot of money for a family.
So I think that's one of the things that I hear people ask is, are rates going to go back down? And I almost feel like if you look historically at how things are going, we're probably not going to see that. So should you wait to buy a house and hope that the rates are going to tick way down again, or should you just roll with it and think that we're probably in a fairly steady increase in interest rates? What can you tell people who are looking to buy now, first thinking, are they going to drop again?
Yeah, I would not recommend waiting for an interest rate drop to buy a house, because that could take years and years. Okay. What I do when I'm talking with my buyers and educating them, especially the younger first-time home buyers, if everyone has their own reason for why they want to move. People are always going to want to buy another house or a new house, a bigger house, or they want to get out of renting and own something. Then as long as you can understand the finances of that type of a purchase. So what's my monthly payment going to be? And what kind of down payment do I need? When you run through those numbers, the interest rates, I hate to say they don't matter, but when it comes down to what you actually earn as a household and what you're going to spend on your house, those are the numbers that matter. So if you want to go and buy a house, I'd say take the time to get educated of what's it going to cost me, what's my monthly payment going to be, whether the interest rate is 5.5% or 3.5%. What does that mean for an actual mortgage payment? And that's what really drives most of our buyers to be motivated to say, oh, okay, these numbers actually, this isn't as bad as I thought it would be. It's not as scary as I thought. Now I'm ready to go and take that next step.
So then my fifth question, I believe it's 5, maybe I missed one. But my fifth question is, does it make sense, or what does it mean to actually buy a point towards your loan?
Yes.
What does that mean?
So when you hear the term pay a point in a mortgage, that is 1 point is 1% times your loan amount. So if you have a loan amount of $200,000, 1 point or 1% is $2,000. Okay. So when we go through mortgage options, rate options with clients, we always break down a handful of different options, starting with what we call the par interest rate. So what is the market rate today with no points? Okay. So let's say, throwing a number out there, it's 5.25%. Okay. And your loan amount is $200,000. Well, if you pay 1 point, so that's an extra $2,000 closing costs. So just another line item at your closing that you bring to the table. Then $2,000 might drive your interest rate down to say 5%. Okay. So paying a point can get your interest rate lowered by maybe 0.25%, maybe 0.3%, just depending on the scenario. It depends on a lot of different factors, but that's the concept, is you're paying extra fees to get a lower rate, which over time can save you money. So we always walk through that exercise with our buyers to say, okay, option A, no points. Option B, paying points. And let's look at what that monthly payment actually saves you. And then we can figure out if that extra investment at closing is worth the money and how long it would take you to earn that money back in your monthly savings.
Got it. Okay, that makes sense.
So we are seeing more buyers wanting to explore or actually deciding to pay points.
Right, and I've heard people talk about it with rates going up a little bit right now.
Yeah.
Okay, so that is 5 questions for our Friday 5. I'm gonna have Matt leave us with one tip. If you are a buyer in this market, what should you do with your mortgage?
Well, you should get pre-approved as early as you can, just to go through that fact-finding process.
Okay.
A lot of buyers, there's a big misconception that a pre-approval means I have to find a house and put a contract in 30 days, and my credit's gonna get damaged if I have that credit run. So that is not the case. So if you just contact somebody that you trust that has experience, this guy, we will walk you through. It's more of an education process. And a lot of people, it's very eye-opening because they realize, oh, okay, I'm paying this much in rent and I can actually maybe afford a house that I would actually want to purchase.
Right.
And it's not that big and scary and expensive.
So the one thing I'm going to leave you guys with is that the interest rate on rent is 100%. So think about that. That doesn't make our rate seem that high today. So thank you, Matt.
Yes, thank you.
Happy Friday or whatever day it is that you are watching, and thank you very much.
Cheers.